Hello and welcome to Live Wire Markets. My name is Chris Conway. Today I'm sitting down with Dr. Philipp Hofflin, Portfolio Manager and Analyst at Lazard Asset Management. Philipp joins us for Live Wire's Income Series for 2024. Philipp, thanks so much for sitting down with Live Wire for our Income Series for 2024.
Pleasure to be here, Chris.
Lazard's focus is on value investing, Philipp, and the Lazard Select Australian Equity Fund has done well over the past 3 years, 15% per annum. Congratulations. Before we shift the focus to income, I just wanted to see how you're seeing the opportunity in value investing. Is it sustainable given US markets are at record highs?
I would say that we now have evidence in the US that value investing hasn't just done okay, but it's actually done incredibly well over something like 200 years. Right. And in those 200 years, there were a lot of bubbles and a lot of booms and whatever. So I think it's going to be okay. But I would just rather sort of get talk a little bit more about that, because in terms of sustainability, because there are really in the short term 2 ways you can make money on the market. The earnings of your stocks go up, or the multiple goes up. And the former, I think, is the sustainable way of creating wealth in the stock market. You really need to own more earnings or cash flow. Cyclical multiple inflation is nice while it lasts, but it's not really a sustainable way of adding value. And if you just think about Australia, over the last 5, over the last 10, over the last 15 years, the cumulative EPS growth for the MSCI Value Index has been above that of the MSCI Growth Index. So where it matters, I think value is alive and well. Now, having said that, the sort of market cap increases for some of those stocks in the US is just staggering. And yes, people do notice that, and it does have an effect on Australia. In fact, really every single tech boom we've had has come with a Made in USA label, right? Because we do mining booms really well here, but we need the US to drive tech booms. So what we have noticed is that yes, once more people are starting to pay more for high multiple stocks, emboldened by what's happening there. But as I say, I don't think it's a sustainable thing. Who knows? It could have ended yesterday. We don't know. And just lastly, very quickly on what's driving that in the US, because of course that's the big topic. And give one thought on AI, because it's neural network AI has been close to my interest for a long time. When I was a graduate student, this was one of the first neural network AI summers. And I have some of my children are in this area now. All the way back in 2011, Marc Andreessen famously said, software is going to eat the world. And software has done very well, since then. Well, more recently, Jason Huang has said AI is going to eat software. And I just want to tell you what I think his thinking there is. And it's the fact that, if you are a good software producer, part of your moat is that you have a dedicated team of programmers, that continually improve your product. And a lot of software companies, what they provide is a great user-friendly product for white-collar people to manage, inventory, logistics, interface between, across the supply chain, customers and whatever. And for them, rapid AI progress is bad news. In 2 ways. The first thing is that AI is going to be very good at programming. And the best programmer in the world may in fact be somebody who is a person who has the best AI, not that company anymore. But much more existentially, some of those businesses are just going to disappear. You don't need humans with user-friendly interface. User-friendly means human-friendly. If you replace admin eventually with AI, the AI is the agent and the software in one bit. You don't need to click on anything or drag on anything really conveniently in. It all gets done by the AI level. And there are severe threats, existential threats for various software businesses. And that's what Jason Huang meant when he said that AI is going to eat software.
Philipp, I have so many questions there, but we must keep the focus to income, which is why we're here today. So we'll shift back to that and we'll focus on the Lazard Defensive Australia Equity Fund, another fund that is double-digit returns over the last 3 years, 12.4% per annum if I'm not mistaken. The Aussie market, it's trading near all-time highs. The 12-month forward estimated div yield for the ASX 200 is currently hovering just below 4%. You would know that the historical average is around 4.7 since 2005. How are you seeing the equity income opportunity right now, especially given you've been doing this for 30 years now, Philipp?
Look, I mean, there's no denying that the market's gone up, 15% since October. So all other things being equal, the future returns at some stage are going to be 50% less. So that's not good. Having said that, the market isn't actually very expensive. And if I just sort of step back a little bit further in terms of the history, I've got 150 years of ASX dividend yields. And if I assess them on a gross basis, then the current yield is, and this is just simple trailing, because we didn't have forward yields back then. Yep. We're at about 40th percentile. So if the lowest yield ever was 0 and the highest ever yield was 100%, we're at about 40th. So a little bit on the expensive side, but nothing really dramatic and nothing that gives you actually a real signal. And if you look at various other measures, cycle adjusted P ratio and so forth, they all tell you the same thing. We are a little bit on the side of expensive, but at the same time, there's no real signal on a historical basis. Now, if I just sort of, again, get to the question of the threat that's out there, because we've had a lot of interest rate rises, and there's a chance we get a downturn from that, then I think it's quite useful to see what has happened in the past to your income level during recessions. So a lot of people usually focus on the price index as it goes up over time and the drawdowns. Well, instead of looking at the income stream, the historical evidence is that the typical recession, and includes some serious ones, lowers your dividend income stream by about a third. And typically, it takes you about 5 to 6 years to get from peak, trough, back to the peak. 5 to 6 years. So there's no doubt downturns hurt. At the same time, they're not the end of the world. You always get back to your peak, and you keep on going after that, and you get increases after that. In fact, in the very long run, again, 150 years, in Australia, dividends have grown by 5% per annum, which is a very nice number. And what I'd like to actually do is just illustrate what that 5% means to you. So just imagine, Chris, that you had an ancestor who was a great benefactor, and back in colonial New South Wales or Victoria, he set up a trust for his descendants of $10,000, fully distributing trust, so all the income gets paid out. And then in that first year, if you'd invested in the stock market, you've got $600 of income from the 10,000. Today, 150 years later, that dividend would be $600,000, which is quite a bit of money. Now, in contrast, if you'd put your money into cash, then back in 1874, you would have got $500. And today, if you put that money into a TD at Westpac, you would get, well, $500. So in the long run, you're much better off, in terms of income generation in equities. But there is always the short term. So I said, look, typically, in a recession, the dividend income stream falls by a third. The worst ever, by the way, was 50%. What's going to happen to your cash return if you get into a recession? Do you reckon it will fall 50% or 60 or 70 or 80? Right? Interest rates get cut. So it's all to put these things in perspective.
Let's talk about the portfolio holdings. There's a couple of key overweights and underweights that I wanted to work through, Philip, if we may. Firstly, underweight financials. So the big banks and insurers, they have done quite well recently. The banks being near all-time highs, or CBA in particular. Traditionally solid dividend payers as well. Can you just take us through that underweight there in financials?
Yeah, look, we do have an underweight in financials, but actually it's composed of a big overweight in insurers.
Right.
And an underweight in the major banks. As you said, they've done very well. To the end of the last quarter, each of these sectors had done about 30% total return over 1 year. If, however, you look behind the scenes, very different drivers behind that. Over that 1 year, the earnings estimates for banks fell 8%. So more than 100% of the price gains were in fact just multiple. Yep. For insurers, earnings revisions were plus 15%. So a fair whack of the price gains were in fact backed by higher earnings. And it's so very different drivers. And as you can imagine, as a result, and you alluded to it, bank multiples are now really, really high. In fact, in Australia, both headline and adjusting for the credit cycle, something like a 45% high, which is a fair time. Well, let me try to put it, a slightly different way for you. Let me compare Commonwealth Bank, our biggest bank, with the biggest bank in the US. Right? So Commonwealth Bank trades on, it's it's a staggering number to quote, 23 times forward earnings. Doesn't get said about a bank very often, Chris. 23 times forward earnings. It's on 3 times book. And for that, you get a return on equity of about 13%, so 13%. Now, if I contrast that with the largest US banks, that's JP Morgan. And JP Morgan is the largest bank in the US, but only has 8% market share. So it grows quite fast because little banks keep on failing, and Jamie Dimon just buys them for $1. Yep. So it has much better growth prospects. It trades on 12 times, less than 2 times book, and it generates an ROE of 15%. So in Commonwealth Bank, you're paying about double for something that probably has lower growth in the long run and is less financially productive.
Let's talk another one of your underweights. It's materials. Traditionally not the best dividend paying stocks, as you would well know. Have paid some hefty dividends in recent years, however, of course, when their profits were through the roof and they weren't spending any money on CapEx. Can you just talk us through that positioning?
So we're underweight materials. We sort of balances a little bit the overweight in energy. We do have Rio, we have some Whitehaven, although that falls more in the energy bucket. More recently, we have dipped our toe into 2 sectors that have had a really tough time. Yep. And I should name these as nickel and lithium. Okay. Right? Both of these were red hot transition metals just 2-3 years ago and trading at phenomenal valuations, and so did the stocks. And we've sort of dipped our toes into these. But very importantly, we are in companies with very strong balance sheets and very low costs, because you need to be able to survive the difficult times, to be there for the times when they get better and they once again print enormous numbers. So in nickel, we're Nickel Industries, which is in Indonesia, and uses that new Chinese technology that is causing so much grief for our nickel producers here. So they've come into the bottom of the cost curve. And in terms of lithium, we are in IGO, which owns part of Greenbushes in WA, which is the best spod mine in Australia. And even at the low of the lithium price recently, they're still very nicely profitable. So you need to be very selective.
Fantastic. You've referenced it just there, Philip, energy, one of your overweights. Consumer staples is the other one. 10% plus for each of those overweights to 31 May. Can you just talk us through maybe the consumer staples, because obviously you've already spoken to energy.
I should probably explain the energy, given that it is a big weight. And in terms of what's behind it. And what is behind it, Chris, is just the valuations, right? Let me just run you very, very quickly through one of the stocks, Woodside, right? Mm-hmm. Everybody knows about Woodside. It's one of our very large caps. At spot prices today, trades on a 15% cash flow yield. Now, we have much more conservative prices. We're value investors. We like to have a margin of safety. Yep. So, but even on that, it's a 10% cash flow yield. That's a very good starting point. The forward dividend, about 6% fully franked, so it's 8% gross. That's not bad either. If you worry about risks, well, it has a phenomenal balance sheet because they did that BHP Petroleum transaction really fully with equity. Break-even cost of production is $15 a barrel oil equivalent, so incredibly low. They always make money in a cash sense. And they are, of course, in exactly the right place for the Asian gas opportunity. And it's really very significant. Penetration of gas in Asia is less than half it is in the rest of the world, and it is a growing market. So in a growing market, you need to probably at least double that, that ratio. By far, Chris, the largest attainable decarbonisation opportunity on the planet is substituting, gas instead of coal in Asia and in China in particular. Right. Now, if I get to those consumer staples, look. Bread and butter names like Coles and Metcash, Collins Food. And very recently, a slightly more interesting one, namely we've bought back into Domino's. Okay. So that stock fell no less than 75+%. It's been very painful, and it's gone from really outrageous expectations that a company was never going to meet to being actually quite attractively priced. Right. And it is worth mentioning that obviously supermarkets are very defensive. We know that they sell essential groceries, but similarly, fast food or quick service restaurants too are very defensive economically. If you go back to the US and you look at the large fast food operators there through the GFC, which was a crunch of a consumer recession, you can't see it, right? Because what happens for those players is people trade down, right? Because they're the cheap alternative. So all very defensive.
And we've just seen the Guzman y Gomez IPO get away as well with some success indeed, absolutely. Philip, we've touched on it throughout the conversation, the key characteristics of companies that make it into the portfolio, of course, because you have the dual objective of providing income and capital growth. So could you just summarise what those key characteristics are?
So I spoke a bit earlier about what we see as a sustainable dividend and those three factors, sustainable payout ratio, obviously the earnings, and also the balance sheet needs to be there. But we also have a hurdle, which is that we will not buy a stock if it doesn't have capital upside. Okay. Just because the dividend is nice doesn't mean that you want to lose money on capital. So we do not want to trade those two off. You can do that. And for example, there are funds, of course, that use derivatives to do that, right? In fact, using derivatives, you can generate any upfront yield you like, but you're eating into your capital doing that, and we don't do that. And those two hurdles mean that you can end up with a very different portfolio than if you just went for maximum yield. Much more defensive, much better characteristics in terms of its sensitivities to the market ups and downs.
Philip, can you give us an example of a stock that meets the criteria, maybe one that you've added recently or a high conviction position in the portfolio? I know you've already talked to a few names.
I mentioned some of the things we added recently. Look, one stock that's worth mentioning, is to talk a little bit more about what I didn't speak about earlier when we spoke about banks and insurers, and that is, we have IG and Suncorp. Mm-hmm. We just talked to Suncorp as an example. Had this for a little while. It's already done well, but we still like it a lot. As you know, it's that Queensland a bank assurance business. They're selling the bank to ANZ on very favourable terms. They were fortunately struck some years ago when bank valuations were better. The core business is its general insurance, and it is in a very strong cyclical upswing. We've had a very strong premium rate cycle globally and domestically here. It's a pretty good business in the sense that it's a very consolidated market in Australia, together with Insurance Australia. And it's absolutely a duopoly in New Zealand. They're going to make something like a 17% return on tangible equity this year. And if you're worried about the economy, and there are reasons to do that always, but particularly now, it's a pretty defensive business, right? Because you have to insure your car, really.
It's the last thing people get rid of.
And you have to insure your house. And if you have a mortgage, in fact, it's legally compulsory to insure your house. So there's always the risk of noise in these companies because you get weather events. But really, on the underwriting side, the profit is pretty much locked in for 24 and 25 for these companies. It's one of the better periods for general insurance.
Philip, just on that, a follow-up, if I may, is it sustainable? Are those price increases for the consumer at the other end? Now, hopefully for you they are, and for Suncorp they are, but are they, we've seen some ridiculous price increases in terms of premiums.
In part, they are sustainable because they're based on some rising input costs. Mm-hmm. Let me just call out two of them. Fundamentally speaking, one of them is reinsurance costs. Right. They've risen a lot because the rest of the world used to give us a very easy pass on reinsurance because the global reinsurance companies used to say, well, Australia is really great because it's completely diversifying. It's not correlated with Northern Hemisphere at all. It's unique. But then they got hit too often, and in the last couple of years they've put in some very big increases. Right. But the second thing is home insurance. It's construction costs. I mean, what's happened there. Yes. And the other one is cars. Well, for motor, we do know what's happened to those costs and the wage costs of smash repairers and so forth. So some of that is in fact sustainable. But there is very distinctly a cycle in the premium rates. It's quite a long cycle, where we're currently in a big upswing, and one day, yes, it will ease off, and we in fact put that into our numbers. But we also value the upfront profitability that's going to be elevated for the next couple of years.
Philip, how do you see the landscape for equity income investing evolving over the next, let's call it 12 to 24 months, particularly as company earnings might start to deteriorate a little?
Look, Chris, if you're in equities, you are going to have exposure to the economy, right? There's nothing really you can do about that. What you can do, though, is you can try to mitigate that. And that gets back to some of the things that I spoke about. You can be in companies that are sensibly geared. Mm-hmm. You can be companies in more defensive sectors, companies that have a sustainable payout ratio, not an unsustainable one. And lastly, you want valuation support, because one of the things that happens in a downturn is that the market goes from being perhaps a bit frothy and willing to value blue sky to being very straight-laced and sober. And that's when investors, they want to see the earnings today and they want to see the cash flow and the assets and so forth. So in that sense, valuation support really helps. And if you do all these things and you use our process, you can end up with quite a defensive portfolio. So for instance, the beta for the defensive fund has been about 2/3. So beta, of course, measures how much you go up and down with the market, so it's very subdued. More importantly, what's called the downside capture ratio, which is in months when the market falls, how much does the fund participate? It's something like only 50 to 60%.
Right, wow.
Something that we're very proud of over the last 12 years. So you can't avoid risk in equities, but you can mitigate it. And sort of to get back to the numbers I spoke about earlier, and the stats I gave, well, you can do even better than that if you invest with that in mind.
Philipp, last one for today. The segment that we're participating in is called Views from the Top. And as we mentioned earlier, you've been doing this for quite some time now. What is the one thing that you've learned over your journey and from the position that you're in that you wouldn't have learned if not for the experiences?
You interview a lot of fund managers.
Yes.
And have you noticed that we're an opinionated bunch?
Once or twice, yep.
Yeah, once or twice. And you probably noticed that we tend to give our views with a lot of conviction. Yep. Well, one of the things I have learned is that actually we know a lot less about the future than we would like to think we do.
Sure.
And I've learned this through hard lessons. And it has two consequences. Or rather, I want to mention a consequence and give some evidence for that. One of the consequences is that there's one thing you do know, Chris, namely the numbers today. So this is why focusing very much on valuations is so powerful, because the future is as maybe, but you know where your starting point is. If you have a strong starting point of the financial investment, you skew the averages in your favor. But let me give you a very dramatic illustration of why investors do overestimate their ability to read the future. So many of you would have heard of Professor Kenneth French. He's a very prominent finance academic in the US. He's a great website with a database, which is, by the way, freely available. And one of the things he does every year, just once a year, he takes all the stocks in the US, thousands of them, and just ranks them on trailing PEs. Really dumb, right? Trailing numbers, no numbers. And he calls the top 30% his growth portfolio and the bottom 30% are his value portfolio. And he's been doing this for 72 years, since the early 50s. And when we think about these stocks that are at the bottom, for example, why do they have a low PE? Well, they have problems, Chris, right? The market doesn't like the management or the growth prospects, or they're seen as risky, or the structural threats or whatever. They're there because they have a problem. And similarly, stocks at the top, well, the only reason why anybody would pay a high PE is because they expect the future is brighter than today. The earnings are going to go up, so my PE is going to be okay. You buy them for a bright future. And then, of course, what Kenneth French also does, he monitors what happens between each year, and it gives us an accumulation series. And since the start of that in 1951, the unglamorous value stocks have beaten the growth portfolio 21-fold, 5% per annum. In other words, back then you would have started investing money, and in the glamorous growth stocks, you might have $1 million today. If you systematically invested in the stocks where people are quite pessimistic and they're on low multiples, you'd have $21 million. It is a staggering gap. And what it tells us is that for 7 generations, US investors thought they could tell good companies from bad ones, but you know what? They couldn't, to the tune of 5% per annum. So one of the things you really have to learn when you're a fund manager is you have to know what you don't know, and you have to be very modest about your ability to tell the future.
Fantastic insights as always. Thank you so much for sitting down with Livewire for our income series for 2024.
Thank you very much for having me.
If you enjoyed that interview as much as I did, make sure to give it a like, and don't forget to follow our YouTube channel because we're adding lots of great content every single week.